This is Argent's December 2023 market view. This is Matt Restuccia, the Chief Investment Officer at Argent. A little bit about Argent. Our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. Follow us at various social media sites and on our blog. So what is the conclusion for this month? Economic indicators suggest a soft landing is more likely than a hard landing. The Fed, or the Federal Reserve, tightening cycle is likely over. This tends to be positive for stocks and bonds. The bull market that started in October 2022 is likely to continue throughout 2024. And why is that? Let's go through some key charts. First, inflation, the most important chart to look at. It is on a downward trajectory. Food at home only increased 1.7% year over year, and energy decreased 5.5% year over year. Shelter, which includes homes, rent, etc., increased 6.5% year over year. That's significant. It accounted for over 70% of core CPI's increase. With affordability so low, I don't see how shelter continues to increase at that rate. So I do think CPI will continue to be on a downward trajectory. In addition, productivity jumped 2.36% year over year, the fastest pace in 2 years. Labor costs only increased 1.61% year over year. Again, that is positive for CPI coming down more. That was partially due to an increase in productivity, as companies don't need to hire as many workers to increase output when productivity is increasing. Productivity happens when there's technological change that is impacting efficiencies. And the more productive an economy, the more it can grow without a subsequent increase in inflation. So all very positive things for the economy and inflation, hinting at a soft landing. In credit conditions, one of the most important things we look at to see if a recession might be imminent. And despite higher interest rates, the availability of credit to consumers and business is favorable. Credit is available to expand your business or buy a home if you so choose. And again, if a recession was imminent, we would start to see credit conditions trend downward, but in fact, they look like they're trending more upward than downward. In consumer health, maybe one of the reasons credit conditions is strong is consumption. About 70% of GDP in the US, and households have low debt service relative to history. So there are people willing to loan to households that have less debt than they have had historically. And when it is low, the gain per annum in real after inflation GDP is 2.6% a year. So again, positive signs. And job openings. So we're seeing wages only increase 1.6% a year, but there still remain 1.3 times the amount of job openings per unemployed in the US. So we still have a healthy job market, but it is getting more in balance, and that's also positive. A downward trajectory in inflation, more productivity, lower wages, favorable credit conditions, low consumer debt service, and healthy demand for labor together imply a soft landing where the Fed lowers inflation without a recession is more likely than a hard landing. And so let's look at what is going on with the Federal Reserve. Investors are now pricing in that the Fed is done raising interest rates and that they are more likely to cut rates than keep rates the same as early as March, just a few months away. The Fed now has more room to maneuver with traditional policy tools than it has had in over 20 years. Therefore, if economic indicators trend downward faster than expected, investors can expect the Fed to lower rates faster than expected. That would support both bond and stock prices. Interest rates would come down, making stocks more attractive and helping to boost the economy, right? Lower interest rates, mortgage rates go down, loans to businesses go down, all very positive. If the economy starts to falter, that can help it stabilize and therefore help the market stabilize. If inflation remains stickier than expected, right? If it remains higher for longer than we expect, it's because consumer strength continues to be better than expected. And that's been the case all throughout the last couple of years. And in that case, the Fed may keep rates in the 5.25 to 5.5% range where they are now, longer than March, longer than is currently priced in. Since this would be due to consumer strength, a recession would remain unlikely, and that is therefore more likely to delay gains and/or cause volatility in stocks and bonds, but not derail the bull market that started in October 2022. And if we look at yields, with the Fed tightening cycle over, yields have likely peaked. They are down over the last month, according to Davis Research. In the last 10 instances between the Fed's last rate hike and first cut, the yield curve has steepened, so we expect to see that, and we are positioned for that. And if you look at a history of bull markets, right, so if we are in fact in a bull market, which I am making the case for, what does that look like? Well, the mean for all bull markets is about an 86% gain over 576 market days. We're about 300 days in, we're up about 25%. So we could have another 60% more to go. But if you look at cyclical bulls within secular bulls, long-term bull markets, this one started in 2009. They tend to last 20 years plus minus. I think we're still in one. Those typically last 751 days, so well past 2024, and return about 105%. So we are well away from those averages. You never know, but that gives you a sense for how powerful a bull market could be. And I think one of the reasons it could continue is that most people, when they look at a chart like this, they look at returns that we've had so far in this bull market. They just can't believe what they're seeing. When we would start to get worried is when there's more euphoria, when more investors think that the stock market can't go down, that everything is perfect and rosy. When we start to see those conditions, that's when we get a bit more concerned and start to get more defensive. So let's look at some things in the appendix. Stock market returns, you can see this goes back to when the bull market started in October, and you can see what's done really well here. You can see that the NASDAQ has done the best. Tech stocks have done really well after really suffering in 2022. And you can see small cap has really struggled. Small cap's the farthest away from its high, about 25% still or more. And the S&P is pretty much at its all-time high. So I do think small cap is a pretty good place to invest. And you can see that here as well. Small cap valuations and international valuations pretty low relative to history here. You can even get the same dividend yield on small cap stocks as you can get in the S&P 500. That is very rare. Usually small cap stocks pay a much lower dividend yield, and they're growing faster than large cap stocks. That is not the case right now. You may even want to look at regional banks, which were significantly impacted this year, but are starting to trend better as of late. If you look at market history, it's best to have a plan, stick with your plan, stay invested, make smart and tactical tilts around the edges based on logical data sets, consistent data sets. That's what we do. If you miss the best 10 days and you miss the best 20 days, and if you miss the best 50 days, your returns were even negative if you miss the best 50 days, or significantly lower if you miss 10 and 20 days versus being just fully invested and not trying to time. So Argent, we have various investment strategies, stocks, macro ETF strategies, private equity, private real estate. We also have bond strategies now as well that we'll be adding, and we started to manage along with our partner at Hightower. Contact us if you want some more information about these. Ultimately, we are customized for our clients, and we do what's best for our clients. We're open architecture, but we do have some strategies that can supplement that open architecture approach. Again, Matt Restuccia, Chief Investment Officer Principal at Argent. Thank you for listening. Have a great week.